Hello and welcome to the Relax. It's Retirement Podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm Wendy McConnell. Hey there, Josh.
Hey, Wendy, how are you?
I'm good. How are you?
Doing wonderful, Wendy. We're finally getting some nice sunny weather here. The snow's melted, so it looks like spring might be right around the corner, which leads me to what we're going to talk about today. Springtime,
Mm,
tax filing time, they kind of
uh,
go together.
no.
It doesn't sound as exciting to you?
No.
Okay. Well, we brought Pete back on today, so welcome, Pete.
Hi,
Welcome,
Wendy.
Pete.
Yes, thank you. Yeah, and you do know it's going to be in early spring, right? Here in Pennsylvania, we have the most famous of weather beings, the groundhog. And
Right.
so
Puck's the tiny Phil.
you got it. And he said that no shadow was seen, so we see sun today. So
Yeah.
it's we think it's a
But we,
great time to talk about the taxes and you know make sure that everybody's in good shape moving into the spring here.
yeah, we had snow over the weekend, though, but we won't talk about that.
That's right. That's right.
Well, over here in Michigan, we didn't, guys. So,
Oh.
No. And that's where you
no.
should be getting it.
We had gale force winds, though, in 12-foot waves. So,
There you go. Oh, jeez.
Wow.
yeah.
Impressive. Okay. All right. So let's dive in. Nobody wants to talk about taxes. Nobody wants to pay taxes, but we have to talk about them and we have to pay them. So what's the deal?
Yeah, so I think today we're going to walk through kind of two main sections, Wendy. We're going to talk about tips for filing, because we got to do that pretty soon here. But then also looking forward, what are some ways that maybe we could reduce taxation in the future or just be more efficient?
All right. Let's get to it.
So Pete and I were talking before, and Pete brought up a great point, and that's about savings rates. So this year, things are a little bit different with interest rates climbing higher. You might be earning something on your savings account now, right, Pete?
That's it. A lot of people don't remember that 5% CD rates were kind of the norm. I mean, we're talking probably 14 years ago. And now that people are starting to see that you're getting a little money back in your savings or your money market, or even on a CD that you probably got, that interest is starting to mean something. It doesn't seem like a whole bunch of cash at the time, but even though it doesn't seem like that much, now you have to do something different this year.
That's right. And you're probably getting 1099s. Just over the weekend, we got an email from a client. Hey, what's this about? And yeah, your savings interest is taxable. We might not have been reminded of that for the last decade because we didn't have interest. But that is one thing that we want to make sure we're reporting when we file our taxes these years. So if you maybe move some money to a high yield savings account, which is something that we've been encouraging folks to do, especially if you're sitting on that cash bucket, that 3 to 6 months worth of expenses, you should be earning some interest on that, but you do need to report that interest on your taxes.
That's it. So that number comes in about $10. So you might have gotten 1099s in these previous years, and you just threw them away, or your accountant said, "I don't need those." And this year you have to do a little bit different. So I know the $10 doesn't seem like a lot of money, but the government still wants to get their cut if you've earned that much. So definitely talk to a tax advisor, but anything that's around or above that $10 amount, you better be paying attention to. So I mean, gosh, I've seen just on money market rates, they went from like a 20th% to now like 4%, 4.5%. So I think if you didn't think you were in this category, I'd look again. And I think that that's one, this is a good time to maybe bring up that most of the mistakes that people make whenever they're dealing with tax is just not having the information, not having the accurate information, just not keeping something, and your records aren't complete. Ultimately, they only matter if you get audited, right? So the IRS comes to you and says, "Hey, we got to take a look. This doesn't seem right." And you got to kind of prove all these things. Whenever that whenever that time comes, it's too late to prepare.
Yeah. And no one wants to go through an audit.
No.
So, I think interest on accounts is something that has caused a lot of audits in the past as well. So certainly, make sure you take a look at that. I think in the same category, Pete, I'd say capital gains, right? If you sold some stock and maybe you had some company stock that you've held for years, you sold that throughout last year, calendar year 2023, make sure that you're reporting that as well.
Absolutely. That's yeah, a lot of these 1099s look the same, but usually they are for those different accounts. So we did see a decent, some growth in some areas in the market last year. So or of course, if you made any sales in your accounts, that's whenever you start getting all those documents, at this time. So yeah, so we did have that's good stuff though. We want to see higher interest rates. We want to see gains in the market. So it's one of those guarantees in life, right?
Death and taxes. That's right. Yeah. Yeah. You make more money, you pay more in taxes. So if you made money, let's be extra careful with our taxes. One of the strategies that we talk to folks a lot about are qualified charitable distributions. This is where anytime after age 70 and a half, you can take money direct from your IRA and send it to a charity. So if you regularly contribute to, local national charities or even just the church, this is a way that you can take that money out of the IRA, send it to the qualified charity, and not pay any taxes on it. So unlike if you put it into your bank account and then wrote the check to the church, that is a tax deduction, but a QCD is a non-taxable event. Where we see folks getting into trouble, though, Wendy, is they take the money out of their IRA, they get a 1099 that lists that amount that actually went to the church on the 1099, and they just go ahead and file the taxes and end up paying taxes on that money anyway. So be very careful. If you did a qualified charitable distribution, make sure if you use tax software like TurboTax, make sure you're informing the software that you did it so that it's properly filing the paperwork. Or, when you meet with your CPA and shake out that financial junk drawer for them for the year, give them a stack of receipts, make sure that you inform them of that.
Why are we having to get a 1099 for that?
That's how it's done. So they file it, and it's your responsibility to report it.
So a distribution, so what we're talking about is from qualified accounts. So these are accounts that have been growing tax deferred. So whenever you were working, you put money from that you were paid into this account before you paid the taxes on it. So they decreased your salary, they decreased the amount of money that you made by that amount. So now, whenever you take those funds out of those type of qualified accounts, traditionally they are retirement accounts, either IRAs, 401ks, 403bs. Now you have to pay those taxes because the government wants their money. You benefited from doing that because you put money in pre-tax. 100% of that money has grown tax deferred. So in essence, instead of, let's just say if you use money in your bank account, you're investing about 15, 20% more right off the bat. So whenever you do take funds from there, that's what we're talking about. You can take those funds out of those qualified accounts, send them directly to a nonprofit, a charity that you hold dearly. And the effect is that charity is going to get maybe about 15 to 20% more from you than they would have if you would have taken out of your bank account. So if I was going to give, 20, $200 and now, I can give 240, I think that's great, and it's going to be about the same difference for me.
Yeah, I was just curious that, we had to take care of that after the effect, that it's not just known that this is a charity or a nonprofit, but, nothing simple when it comes to the government. So I guess that's what you're going to tell me, right, Josh?
Yep. Your responsibility, right? So,
Gotcha.
I think what really happens behind the scenes is if you use a custodian, so let's say like Fidelity or Charles Schwab, they are reporting that you took a withdrawal from that taxable account. they by law have to report that to the IRS. And there is not, well, actually, we sent it to this charity. That's not their responsibility to prove that. That's on you.
Okay, gotcha.
So yeah, but be careful around it. I think I don't have data to support it, but I'm pretty sure that a lot of people miss that because it's a little bit of a clunky situation. Your 1099 says you took, let's say $10,000 out. If $2,000 of that went to a charity, you need to be making sure that you're stating that and not just paying tax on the full $10,000.
Yeah, and I think just another point on that is that the standard deduction, so the amount that each one of us gets just generically, has increased significantly. And at this point now, a lot of people don't itemize their deductions. So a lot of people aren't going to say that I gave $2,000 to the church because your standard deduction is 12,000 or 13,000. So that's a lot of contributions, Wendy. I don't know if you contribute that much, but of course. But this allows you to, you're taking the standard deduction. So you're probably you don't need to worry about keeping track of all those charitable contributions. This allows you now to give a little bit more to the church. And this is only, you actually have to be a senior. You have to be, you only qualify for this at age 70. So it's not 70 and a half. Thank you, Josh.
We got
70 and a half. That's right.
Now, again, great IRS rules. Thanks for,
So like back to when you were a kid, when you were 11 and a half.
Yeah, that's right. Yeah.
That's
At 70, you start counting half birthdays.
Oh, okay. Good. That's something to look forward to.
So yeah, so this is definitely something that if you don't qualify for it, your parents might. So something that you want to bring up to them, and as a way that they might be giving already, and this is a way that, hey, you can give the same amount, it's going to be missing from your pocket, but guess what? Your charity is going to end up with a boatload more, especially if we all do this.
Yeah. Yep, I think it's just a very efficient way to give. I think in people always wait. I'm guilty of this, waiting to the last minute for things. So I think the other thing to think about before you file is if you're trying to get your taxable income lower, what can I do now? We will say that it's better to do things during the year. We have a lot more options of ways to reduce taxes throughout the year. But right now, we still have two things that we can do. If you qualify, and one is an HSA contribution. So you can contribute to your HSA up to the tax filing deadline. So if you're in a high deductible plan and have an HSA, you can max out that contribution. And I think the other one that we hear quite often and many folks are familiar with is contributing to an IRA. I think one of the things that people overlook with IRA contributions is your spouse. So if you have a spouse that's not working, you can still contribute for them if one of the two of you is working, and as long as your earned income is up to that amount that you're contributing. So that is a often underutilized one. But there are some limitations there in terms of your income. So,
yeah, I was going to say about the spouse side, remember that if your spouse is not working or they do not qualify for a plan, the limits, you can always contribute to an IRA. So I think Josh is going to dig into maybe whenever you wouldn't, but that's a good point on the spousal contribution, as a lot of people don't think that, but I wasn't working, or I wasn't getting the W-2 income. I wouldn't say that they weren't working, but how can I contribute to my own retirement? And that also helps decrease the salary that was earned on the working spouse.
Yeah, and I think that deductibility, I guess, was the other point that I wanted to make. For 2024, you're not going to be able to deduct if you're earning more than about $123,000 if you're married filing joint. So if you're higher income, that might not be a good option for you. However, if you're below that or trying to reduce your income below that, an IRA contribution can be a great way to save a little bit more for retirement and reduce taxes in the long term too.
Absolutely.
But yeah, I think more importantly, and one of the things that Pete and I spend a lot of time working with clients with is more looking forward. So after you file taxes, great. Maybe that's a good time for a recap. One of the exercises we do with a lot of our clients is ask them for a copy of their tax return, and then we walk back through that and say, hey, maybe we see an opportunity for tax reduction here, or I didn't realize you had a rental property with rental income. What's going on over here, right? It is a document that allows us to look at things through a different light. So often that is where there's more planning opportunity than after the fourth quarter ended, right? Because that's where we are now. The game's over, so to speak. We really have limited options at this point.
You got it. It's there's a few things that we could do before that April 15th, but there's a lot more you can do right now for your tax filing in 2024. Yeah, doing an extensive and an in-depth tax analysis is really where we see the greatest benefit for our clients. That's whenever we're kicking the tires, we're popping the hood, we're going through everything, and it's hard to do that after the fact. It's almost like let me check on the car after the road trip. It's like, well, guess what? You can probably find a lot more problems if you check on that before and you can avoid them.
Yeah, I think maybe taking a look at last year's tax return as a reflection point to look forward would just be like, watching the tape in sports, or where you're reviewing that and say, oh, maybe on this play we could have done something different. We missed this opportunity. It's the same kind of thing. And I think, in planning early in the year, if we look at these sort of after the games ended, the IRA and HSA contributions, those could be options. But for many of us, we don't just have an extra several $1,000s laying around to all of a sudden write a check for, right? For many folks in those accumulation years, no, we're trying to keep that emergency fund up and pay the bills and everything else. So I think it's better if we're contributing on a monthly basis. So we're still in the first quarter of 2024 here. So if you haven't already, review your 401k contributions, your HSA contributions, and make sure that you're getting the most out of them. I mean, ideally, you're maxing those out every year, especially if you're mid to late career. That way you'll have enough for retirement. But figuring out what that perfect amount is, I know we meet with folks all the time that have a 401k. They're only putting 2% in, but the company matches up to 3%. That's definitely worth looking at. You're leaving 1% on the table there. So,
yeah, I think that's a good point. There's kind of two ways you look at these contributions. One is, okay, what's my match? What am I going to get for free? Is it 50%? My neighbor gets 100% match. Well, guess what? You're getting a 50% return guaranteed right off the bat. I'll take that. So I think looking at those rates, looking at that amount that you get that match, or that company provides a benefit, that's one way of looking at it. And the other way is saying that, hey, it's pretty restricted on how you can and who can contribute to an IRA, especially when we start looking at today's reality with two income families. A lot of people don't qualify for these things. So your IRA, or sorry, your 401k or your 403b, these might be your only options to defer additional salary, to make additional contributions.
Yeah, I think the other opportunity with 401k that we've started to look at a lot more with folks is most plans now have a Roth 401k option in it as well. So you don't get the tax deduction this year, but it allows that money to grow tax-free within the plan and then distribute tax-free. There's some rules around it, but for the most part, we would call that Roth 401k part of your tax-free bucket, right? So we put the money in, we still get the power of that deferral where we're not paying taxes like we are on our savings account each and every year. And then we can distribute that later on in life tax-free. I think especially in retirement, if it's on your bucket list to buy an RV once you retire, or a second home and you're looking to make a down payment, it's good to have some tax-free money that we can pull out of, rather than pulling it out of an IRA or traditional 401k where all that money's fully taxable.
Do you
Yeah.
think that there's a preference, and I guess it's just your opinion of doing a regular 401k or a Roth?
I think it depends on your situation. Pete and I have talked about this a little bit more recently, and I think Pete takes a strong stance on the traditional that, like, for most folks, it makes sense. You need to reduce income. You're going to be spending less. You know, you need the tax deduction now. I think it depends on your situation. One of the exercises we do with a lot of folks nearing retirement or in their early years of retirement is look at what that RMD number might be based on the track they're on. And I think that's compelling evidence. If you're required to take out far more than you're going to need to spend, then we really seriously need to look at whether it's working, contributing to the Roth 401k to reduce that projected path, or looking at Roth conversions as an option as well, because no one wants to be in a position where in retirement you don't need to spend the money, but you're forced to pay taxes on it. That
Right.
gives inflexible tax picture.
Yeah. So, I mean, I just always kind of thought that Roth was kind of the way to go because taxes no
It's
go down, they just go up.
well, I mean, you still have taxes right now, right, Wendy?
Yes.
So you're talking about investing a portion of your funds that you already paid taxes on. So you're taking that 15 to 20% off the top right away. So, like Josh said, I like the tax deferral because of that fact. It's like, if you could tell me I can start off 20% ahead, I'm going to do that.
Okay.
And usually in a long run, a long time frame, um, it's pretty much going to be a significant enough amount that even if taxes do increase, you're still going to be ahead with the tax deferral. That being said, once you start getting close to retirement, it's nice to have different places to get money that, hey, this is something I pay taxes all along. It's my savings. This is something that's tax deferred. It's my IRA. And now here I got another piece of the puzzle I already pay taxes on, and it's grown tax deferred. And guess what? I can take that out. It's not going to bump me up to the next tax bracket. So I'm not going to have to worry about paying 20, 25, who knows more if tax rates do change. So definitely having that diversification on which accounts are growing tax deferred and when, but, definitely if tax deferral isn't maybe you don't worry about paying a little bit more taxes and that's not a big deal. You're already in a lower tax bracket. Then yeah, I mean, a Roth option is great. If you don't need that salary deferral, that's not a benefit that you feel to yourself. You can still benefit from the deferral, from that money growing without having to worry about paying the taxes on every year. So
Right. So have a little of everything, basically.
Yeah, I mean, tax diversification is extremely important. I think the other scenario in terms of Roth conversions that we run into a lot is maybe in the early years of retirement, folks aren't spending all that much. They're not yet at, well, anywhere from 70 and a half to 73. Now, moving forward, 73 for most folks, but they're not at that RMD age yet where they're forced to take money out. And maybe they're living off of a little bit of savings, and we paint their tax picture. We do a tax review with them and say, hey, it looks like you're going to fall in a 0% tax bracket. If there is $5,000 or $6,000 left in that tax bracket, we can actually do a Roth conversion without paying taxes on it. So again, this is during the game. We can't do this for 2023 now. So this is the importance of tax planning ahead of time. You're not missing those opportunities when they're there. For a lot, we've seen that quite a bit. And heck, if we can take $5,000 and make it a tax-free $5,000 from a fully taxable, that's kind of the best of both worlds. When Pete was going back saying, hey, if you have $100, you're in a 20% tax bracket and you put that in a Roth IRA, your starting point is $80. If you put it in an IRA, your starting point's $100. So compound $100 versus $80 and see where you end up. And I think that's Pete's advocacy for the tax deferral is if you're in a lower tax bracket and it grew more, right? Because your engine was bigger, that could make sense. But hey, what if we then take that $100 and actually convert it in a tax-free manner to a Roth IRA? Psh, you can have your cake and eat it too, right, Wendy?
Absolutely. Now, Pete, I have to say, I never really thought of it from the perspective that you explained it. So thank you. I
Absolutely.
understand now more of where that thought process comes from.
Absolutely. Yeah. And I think that's the thing is there's unfortunately, there's no rule book that says, hey, Wendy's only going to pay this much in taxes this year. You kind of got to go through it. You got to go through everybody individually. The results that we get are pretty powerful whenever we do look at somebody's taxes from last year. It usually is pretty obvious to see where things were maybe missed. Sometimes it's painful because it's like, gosh, we left money on the table, but it allows us going forward to have a clear plan, have a clear picture, and really allows us to to invest better and have a much better view of that person's future.
Yeah. Yeah, I think, the other opportunity that we always look at throughout the year is like with capital gains too. So maxing out those tax brackets in terms of capital gains, just like I talked about with the Roth conversions. If you have maybe some old company stock that you've had for a long time and you've been afraid to sell it because, it's all taxable. Well, it might not be depending on your situation. So if we look and do proper tax planning, we can see, hey, maybe we have some space before we're paying capital gains. If you're married filing joint for 2024 here, you fall in a 0% capital gains structure up to $94,050. So you might not be paying taxes on that money. Or again, if it's early on in retirement, maybe one spouse retired or is only working part-time now, there's a lot of situations where that can be a good option for folks. We talk about charitable giving a lot, but kids do not qualify as a charity, Wendy. Don't know if you know that, but sometimes we have adult kids or kids that recently finished school that maybe our clients are helping them out, right? They're giving a little money to help them out, helping them get established, maybe help paying rent. One of the strategies we can do is looking at those highly appreciated stocks. And instead of mom and dad selling them and paying that 15% or 20, depending on their income, that 15 to 20% capital gains, they gift it to the child that's not yet earning much money, and they can pay taxes on it. Again, thinking they're falling in that 0% tax bracket. So it's a more efficient way to give, and we kind of get a charitable, bonus on that money there.
Gotcha. So there's a way around it.
Well, you're gifting. So yeah, there's
All right.
there's some framework you can do there, but charitable giving, as I kind of alluded there to a real charity is something we want to think through as well when we're doing tax planning for any year. Much like we talked about gifting that highly appreciated stock to a child, if we gift that to a charity, that is also a non-taxable event, and the charity's never going to pay capital gains on it. So again, that's an additional 15% that gets to the cause that you care about, rather than Uncle Sam. Unless Uncle Sam's the cause you care about. That could be it.
I don't hear that
That's
very
right. That is true. You don't have to just give from those qualified accounts. You can give from, multiple different sources and still benefit from some sort of, a IRS, I don't know what you want to call loophole or whatever. Hey, you don't have to worry about paying taxes on this side. So, just because you don't have one of these accounts or the other, it still is beneficial to do a comprehensive tax plan.
Yeah, absolutely. And then having that framework set up, one of the things that we've had occur a few times is near the end of the year, maybe your company's doing layoffs. And since you're near retirement, they say, hey, Pete or Wendy, we're going to encourage you to go by giving you a really nice severance package. And
Why not Josh?
well, because I'm saying anyway, but let's say it's 6 to 12 months of your regular pay. Well, all of a sudden you doubled your income for the year, right? Or 1.5 exit at the end of the year. Oh, man, is that painful if they pay that out at the end of the year, because you're bumping up tax brackets then. So in a situation like that, we look for ways to, defer, reduce that taxation as much as possible. One of the things that we've worked with clients on is figuring out what that charitable budget is, maybe for the first 7 to 10 years of retirement, and donating it all at once to a donor advised fund that allows you to then grow that money and distribute it slowly out to charities, but get the tax deduction on day one.
Okay.
You got
So,
that, Wendy?
I think, yeah. Well, if I have questions, I'll just call you.
Perfect. And that's what we encourage folks to do
Yes.
as well. In the show notes, we'll have a link to our calendar where you can schedule a 15-minute call. If you think doing a tax analysis might be saving you a bunch of money, we're happy to help you with that. So feel free to schedule that 15-minute phone call.
And what is the website, Josh?
It is leonardadvisorygroup.com.
And if somebody wants to get in touch with you personally,
Ooh, they can email me at jleonard@leonardadvisorygroup.com. If they want to talk to Pete, they can go pete@leonardadvisorygroup.com. And if they want to give us a call, 412-998-PLAN.
all right. Well, thank you for the education today. I appreciate it.
You're quite welcome.
Absolutely. Yes. You're very welcome, Wendy.
And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.